Good morning, everybody, and thank you so much for joining. We're really delighted to have you here with us and our panelists as we discuss fintech at the frontier of MSE finance. On behalf of CGAP, I'd like to welcome our panelists today and all of the participants. I know it's quite early, especially on the East Coast of the US, so we really appreciate everyone taking the time. I'd like to introduce my colleague Liz Kiamba and myself. We'll be moderating the session jointly today. Liz and I work with the MSE finance team at CGAP, and we look at all of these issues that we hope to be discussing with the panelists in great detail. Just some quick logistics and housekeeping points, requesting all the audience to keep their mics muted for the duration of the discussion. Please post all of your questions on the chat. We have a dedicated time at the end of the session for Q&A. And if we can't get to all of your questions, we promise to try to answer them by email. This panel discussion will be recorded and it can be shared with the panelists and all of the participants if you would like. Quickly, in terms of agenda, I'm going to do very brief opening remarks and frame the discussion for today. And then Liz will lead you into introductions with our panelists. Liz and I will jointly run a moderated discussion for about 30 minutes, and then we'll leave 10 minutes at the end of the session for Q&A. As I mentioned, if you've got any questions that we can't get to, please feel free to email them over and we'll be happy to try to answer them by email. We'll close the discussion at noon here in London and 8 a.m. EST. So jumping right into our discussion for today, there are nearly 500 million or half a billion micro and small enterprises in emerging markets. These enterprises are crucial because they provide livelihoods to millions of low-income households. Although there's been decades of investment and research in how these enterprises can be made more sustainable, in fact, one of the factors that's most critical to their sustainability, the access to timely and adequate finance, continues to remain a huge constraint. The micro and small enterprise sector faces a combined credit gap of nearly $4.9 trillion US, clearly reflecting that there are some limitations in the way in which traditional financial service providers have tried to address this segment. So over the past 3 years, CGAP has been doing a lot of work in this space of MSE finance. We've tried to look at the issue both from the demand side as well as the supply side, while also looking at the impact that financial services have had on the MSE sector thus far. So to build a better picture of who are these MSEs and how do we go about addressing them, in 2021, we conducted primary research with nearly 400 micro and small enterprises in India, Kenya, and Peru. The idea was to just understand who these enterprises are, who are the owners of these enterprises, what are their goals and their motivations, what are their attitudes towards finance, what are their financial aspirations, to understand how their income generation and livelihoods are impacted by financial services and what role these financial services have in supporting their livelihoods. The idea was to also try to come up with recommendations for financial service providers to tailor their offerings in a way that better addresses the needs of the MSEs. From these discussions, as well as discussions with a variety of other stakeholders in the MSE ecosystem, one thing has become increasingly clear, that advances in technology are allowing digital finance providers, such as those represented by our panelists, to provide solutions for micro and small enterprises that didn't exist before. And we finally see some potential and great promise that their financial inclusion needs can be met. So on the supply side, CGAP will soon be releasing a publication that evaluates the effectiveness of very specific models in reaching these micro and small enterprises and how the use of data is changing the game. Some of the models that show the most promise are data-driven lending models, peer-to-peer lending models, and embedded finance, most of which are represented with our panelists today. Importantly, however, while digital finance shows some great promise in addressing the financial inclusion gap, there are some key issues that remain. Primary among these, based on our research, are a lack of trust in providers, coupled with low digital financial literacy. And the problem is that unless these challenges start to be addressed, we might go back into the same loop with digital finance providers also not being able to meet the needs of the MSEs in the way that traditional finance wasn't. So it's very important for us as we continue these discussions to remain cognizant of these challenges. So while CGAP strongly believes that fintech is in fact very much at the frontier of MSE finance looking forward, there are a few questions that still need to be answered. Those are the questions that we hope to answer with our panelists today. These questions are, what are some of the most innovative models that are emerging in the fintech space? How did they address the financial needs of underserved MSEs, particularly the smallest MSEs, most vulnerable and thin file customers? And what do these models do that's different than what traditional finance has done? How can these models be used to reach the most vulnerable MSEs, including those that are currently excluded or hugely underserved and don't have as much of digital awareness and financial literacy? How do we address the trust deficit? This is absolutely critical. What do we do to ensure that the trust deficit that exists is addressed by digital finance service providers? And then what are the challenges that digital finance service providers are still meeting? How do we ensure that they can actually address the needs of the MSE? And what support do they need from the ecosystem to address these challenges? So without further ado, I'm going to ask Liz to introduce our panelists and we can go into the discussion. Over to you, Liz.
Thank you, Swati. It's my absolute pleasure to introduce our panelists today. First off, we have Tyler Karahalios. Tyler is the head of financial services at MarketForce. Next, we have Kaylee Talpert, who is the executive vice president for business development at Anne Friends. Then we have Daniel Maison, who is the head of SME growth at MFS Africa. Did I pronounce your name right?
Maison, thank you.
Yes. Then we have Raman Taneja, who is the Chief Product Officer at Earth Finance, and then Maurice Iwunze, who is the CEO and co-founder of Simplify. Welcome, and we're very glad that you could join our panel today. So just to understand all those institutions I've mentioned next to your names and your roles in those institutions, could you kindly give us a brief introduction of your organization, the target segment that you aim to address, your business model and the innovation around it, and perhaps share your experience serving this target segment? What is the one thing that you've learned about serving the MSE segment in the last 1 year? And do you agree that MSEs need a differentiated approach from that of other enterprises? First off, let's start with you, Tyler.
Thanks so much, Liz and Swati. I'm used to my name being the one that gets butchered, so I appreciate that there. So lovely to be here today and to be chatting with all of you. I work at MarketForce. MarketForce is building a super app for informal merchants across the African continent. So we started with a B2B commerce platform where merchants can order FMCG goods, sell bill pay services to end consumers to earn a commission, and then also access financial services, including a digital wallet, payments, and inventory finance or lending. We're primarily serving your corner shop, your mom and pop store who serves consumers within walking distance of their shop. These folks are technologically curious. Many, but not all, have a smartphone, but they are still largely, you know, as we've discussed and as Swati's stat showed, largely underserved commercially, digitally, and financially. But we're able to leverage what I think is really unique, their transaction history with us, in order to create better informed lending decisions and provide faster and more accessible access to inventory financing and financial services. You posited, Liz, if this customer segment, if MSMEs need a differentiated approach, I would say consulting firms would probably go out of business if folks didn't do deep customer segmentation research. I think, yes, absolutely. You have to look at their digital access, the regulatory environment they're operating in, what they're pushing through their business. And I think one thing we've really learned in the last year about serving, especially micro and small enterprises, is that they do prefer a phygital approach. So we have an offline, online approach, both an app and an in-field agent network. And this helps us build that trust and then develop a digital first comfort for them in which they can access financial services. Thanks for having me.
Thanks, Tyler, for that. We'll hear more about the phygital approach later in the discussion. Next up is Kaylee Talpert. Tell us more about Anne Friends.
Great. Hi, everyone. So we are also a big data-driven B2B commerce platform that was really developed for the last mile in emerging markets, developing countries. Our current focus is Southeast Asia. So we are live across Indonesia, the Philippines, and recently entered Vietnam. And what we've actually got a very unique model in that it's kind of similarly FMCG focused, working with key partners and also with financial institutions. So Coca-Cola, for example, is a leading strategic partner. We're working with them globally and across our different markets. We work with Unilever, with Freezer and Campina, Perfetti, kind of core FMCG partners. And then we work with our financial institutions. We've done some very interesting work with the IFC. We're working with CGAP and then also local financial institutions and payment providers. And what we do is we digitize these last mile FMCG value chains, combining the trade finance aspect. But I think what really differentiates us is we're an asset light model. We're not coming and building warehouses. We're not offering a marketplace. We're not buying goods. We're not selling goods. We actually hook into the local value chain, the wholesalers who have been doing this work for the past 100 years. And we say, partner with us, we're going to digitize you, we're going to transform you, and they really become our long-term partners. We're not trying to get rid of the middlemen. We say those middlemen are there and we want to support them, make them more efficient, optimize them, and use them to serve these small micro last mile retailers. And it allows us to have this very much asset light, flexible model where we don't have to then make those investments in CapEx and inventory. And that's why we've been able to expand very quickly, starting from our work we were doing originally just with Coca-Cola, and then moving to the Philippines, Vietnam, and bringing on board these additional partners. And I think for the purpose of today's discussion, I'll talk a little bit about some of the value chain models that we've built and our learnings from them for offering consignment, for offering buy now, pay later, for offering lending products that are really uniquely tailored to the value chains. So I think that answers the question. Do they need unique models? Yes, unique models, unique technology, unique business models. And I think something I've learned from these small micro retailers is they're incredibly resilient. As much as we were also worried in COVID and they really took a beating, and we'll talk a little bit about the trust and the risk and all of that, they're still there and they're still key, and they're still the place where 80% of the population are buying their daily goods and services. So I think this conversation is very much pertinent of how to further support them and help them to grow.
Thank you so much, Kaylee, for that. Daniel, tell us about MFS Africa.
Hey everyone, my name is Daniel Mason. I work for MFS Africa, which stands for Mobile Financial Services. Company is about 10 years old. And the why of MFS Africa is making borders matter less on the continent. So very simply, the company started with the idea that mobile money and the sort of infrastructure of that the telcos provided, and mobile money wallets was the way in which financial inclusion could happen, and therefore built a hub that was a network of networks. So MTN Uganda is very different to MTN Benin from an infrastructural perspective, from a technological perspective, from a currency perspective. And of course, you have a lot more fragmentation with all the different telcos across the continent. So they basically has put together this whole hub that puts all these networks and avails that to remittance companies, to banks, to SMEs, to large enterprises, and has done very well for itself in terms of bulk collections, disbursements, and has then now become an omni-channel company. So what that means is that it's not only looking at mobile money wallets, it's not only looking at banks, but you now have cards, you now have agency networks across the continent. And what I do is I'm head of SME growth. So this is a happy place for me with my co-panelists. I'm very passionate about anything and everything that talks about inclusion. And the last question was, sorry, you did ask about innovation. So we have a platform called Bionic, which is a software as a service, a web-based software as a service that speaks directly to SMEs for whom the bare telco offering in terms of collection and disbursement is not enough. So that's what we do: streamline payments for SMEs across the continent. Yeah, I also resonate with Kaylee's comment about resilience. COVID was a hell of a revealer of truths, let me put it that way. Showed a lot of resilience, showed us a lot of the oversight that was there, made us get very, have a lot of innovation in terms of how we get data and how we can truly be of service in what we do. Thank you.
Thank you, David. Looking forward to the continued conversation on your experiences. Next up is Raman Taneja. Could you tell us about Earth Finance?
So hi everyone. So myself, Raman Taneja, I represent Earth Finance, our digital loan. We are based out of India. So we cater to micro SME segment. In terms of micro SME segment, if you double click on that, so we have close to 630 million MSMEs in the country. We cater to the small M of MSME, which is, I'll say in terms of revenue, top line is close to 1.2 million Indian rupee. So in terms of target segment, we cater to mom and pop stores. We cater to, I'll say business correspondent agents. We cater to pharma. So these are 7 segments to whom we cater to. We follow a phygital method here, more precisely, and it all depends on the target segment. So we have both the segments. One segment is basically new to credit segment, which requires a bit of assistance, to whom we reach out on a face-to-face basis and we do the entire onboarding and we offer financial services. Then we have the second cohort, to whom we offer financial services on a self-onboarding basis, where the customers are quite digitally literate and they know how to operate the entire mobile app, and they do the entire onboarding process, and we do the entire credit based on that. We are 3.5-year-old company here. We are women focused, and we are present digitally across the country. In terms of geography, if we say is 18,000 pin codes, and we have disbursed close to 370 crore rupees in Indian context. About innovation, we have basically driven by our target group, our target segment. So we have created a curated approach for both the segments. One is, I'll say, new to credit, or the customers who require a bit of assistance. Of course, we follow the entire digital process, but we all feel that when you reach out to the customer who are new to credit, who have not been onboarded so far, they require a bit of assistance. So we do that. And we follow a lot more approach. It's not just that we reach out to the customer and we do that. A lot of hand holding happens when the entire credit journey or any other product we offer to the customer. We call ourselves as MSME Fintech company. We believe in technology, that we can leverage technology to the fullest, I'll say, potential to reach out to different segments across the country. And I'm looking forward to learn from our co-panelists, and that's it.
Thank you, Raman. Last but not least, Maurice.
Hi, my name is Maurice Iwunze. I'm senior co-founder of Simplify. We are a UK-based fintech company that is building one of the first blockchain-based credit platforms that facilitates access to credit for micro and SME businesses in developing countries. Our goal and mission is really to make capital completely borderless, with the aim of radically increasing inclusion and reducing the cost to the end borrowers. And so in our business model and innovation, we accomplish our mission really by 2 key pieces of innovation. One is leveraging blockchain technology to streamline the process of facilitating capital to micro and SME businesses. We strip out a lot of the middlemen and intermediaries traditionally associated with microfinance capital, and leverage smart contracts to help make that process more direct to end user. And the other innovation around our business model is that we enable immigrants to participate in our value chain by enabling them to provide digital collateral on our platform to help their unbanked family members access capital through our platform. And our customer segments, we really have a 2-sided business model. On one side are capital providers and immigrants that provide collateral, this digital collateral on chain. And on the borrower side, we position ourselves really as an embedded finance solution So we don't directly interact with the end borrower. We embed ourselves in commerce-based digital platforms that they operate and do business activities on, and they're able to access capital through their platforms with us sitting in the back end. I think the last question of what I've learned about MSEs. I think I'll echo what everyone has been saying on the panel, which is there's still a bit of learning curve in hand-holding that these customers require. And so, there's there still needs to be a little bit of patience to get this customer segments to be fully digitized.
Thank you, Maurice. Back to you, Swati, for the main discussion.
Thanks, Liz. That was a great round of speed dating with the panelists. Really enjoyed that. Thank you all. So Maurice, since you went last, maybe I could put you on the hot seat to go first for the moderated discussion. So one of the first themes we wanted to discuss is why we believe that digital finance is, why, when we say it's at the frontier, or fintech is at the frontier of MSE finance, why is that? What's different with traditional finance? Some of the issues that plague the micro and small enterprises, right? Lack of collateral, lack of documentation, low levels of financial literacy, lack of credit history, those don't change. So what makes digital finance different? I know you're addressing specifically one of those issues around collateral, but it would be good to get your perspectives on that.
Yeah, I think it starts fundamentally with just creativity. I think, I come from a traditional banking background, and, banks, they serve a massive purpose in the financial ecosystem. But, they tend to be very bureaucratic and traditional in their approaches to delivering products. And I think what's really valuable and exciting about what's happening in the fintech space is the ability for founders and builders to be creative and have the flexibility and really blank canvas to really think about how to build and deploy products that are more tailored to the realities of businesses that operate today. A lot of legacy institutions are incumbents. Their business models are really still built around legacy ways and people used to operate, businesses used to operate. But digital service providers, have the benefit of basically starting from scratch and saying, if we were to do this all over again, how should it be built? And I think that level of creativity allows you to also to build products that are more flexible to the end user's needs. So I think that's probably like one of the key elements of why digital financial providers are better positioned to address this segment.
Thank you. Tyler, I know you guys, Maurice and you are now working together, so it's a very small world. Do you agree with Maurice? Do you think there's any additional factors that give digital finance a bit of an edge with this segment specifically?
Yeah, absolutely. I think Kaylee and Maurice both mentioned that digital financial service providers are really creating bespoke, fit-for-purpose solutions, and that's core to uptake and accessibility here. We do really deep user research on this customer segment and understand their pain points and their needs, especially in their financial services journey. And we're able to create lending products, financial products that solve for those needs. I think also, we bring in the data-driven approach. So historically, the onboarding process to access financial service has been cumbersome, in-person, painful. But a company like MarketForce can leverage our transaction history with that merchant to create data-driven informed lending, which de-risks the provision of financial services, but also makes the process more accessible and convenient for the MSME and easier to meet them where they're at, which is how you get them onboarded and using the services.
That's very interesting. So I think also, Kaylee and Raman and Daniel talked about sort of the resilience of MSEs and how they've all managed to survive the COVID pandemic. Kaylee, it would be very interesting because your model is somewhat your target segment is quite similar to MarketForce, but your approach is somewhat different. So do you think there's any additional aspects that digital finance providers bring to this sector that are particularly relevant?
Sure. I'll actually share, listening to them, our story actually, we started with a bank. When we started this journey in Indonesia, we were running one of the largest branchless or agency banking platforms in Indonesia, 4 million customers, hundreds of thousands of agents, and great product, very innovative team. But something we saw is even, we had a tiny micro loan product. And even though it was a really, really good product, at the end of the day, and to echo what was previously said by Tyler, there was no data to use for this product. And I think that's the key thing is, as much as there's talk and there's buzz about banks and financial institutions wanting to go into the space, if there's no bankable data, it's just too risky. And I think that's where players such as us and, everyone in this panel comes in, is it's not a coincidence that there's so many players starting with the FMCG value chains, because it's generating that data and that transactions, and suddenly you actually have the credit history to lend on without having to go and educate and explain. You've just got the transaction data. And maybe just, a small thing I'll add that what I think we're doing is unique is a key part of our model is actually people. Everyone talks about technology and digital, but people drive technology. And particularly when you're looking at the last mile and adoption and, with everything with COVID, it's still a difficult market segment. And we actually built on that learning our model around commerce managers, what we call, which are basically sales agents that are going around and creating these digital profiles and taking orders, so that even if the retailer themselves is not ready to take their smartphone and use it to place an order, they're getting a profile, they're placing an order, we're getting that data. And I think that's a key differentiator, is having those people being in the market, having the right business model, that we're generating revenues from the FMCG value chain, and then we can then build on top of it as a second layer, the financial services. So maybe that's kind of a key learning I'll share is, from my experience, it's you first need the transaction, the commerce value chain. And then once you have that, you have the data, you have the people on the ground, you have the relationships. It's then much easier to incorporate and embed in the financial services on top of that.
Thank you. So I've heard creativity and flexibility in the way you build products and approach the customer segment. Data, very important. But also, I think, Kelly, what you said, which is obviously going to come up further in our discussion as well, is that you can't go purely digital with these customers because there's a bit of a journey that they have to go through. And so the people are just as important in this journey, while trying to make sure that you build in the convenience and the time efficiencies that the digital can provide. Thank you very much. Liz, shall I hand over to you for the next?
Yeah, sounds like we're already answering the second question, which is around whether a purely digital approach is really feasible with these MSE segments. So I think we all understand what challenges there are in digitizing MSEs, the high cost of data and really persistently low levels of digital literacy. So the question is, should we deploy a purely digital approach? And what I'm hearing already is no, not really. So is a high-tech, high-touch approach more reasonable? And are fintechs well positioned for this? So perhaps we can start with you, Daniel, from the payments perspective and how you've explained that MFS Africa is sort of a hub for payment services, including for payment services for MSEs. Perhaps you can tell us how you see this working, this approach working.
Okay, sure thing. So I've been in the sort of SME space for a while, in e-commerce and fintech, etc. And yeah, I think one thing that Tyler also alluded to is just, hey, digital is here to stay. We have the hardware. There's this whole idea of it's so, things have to be USSD based or text is something that I think is very quickly becoming an archaic way of thinking. It's something that you talked about just now, Elizabeth, about high touch, high tech. I think we can use high tech and low touch in the sense of, just embracing, the very obvious benefits of having pure digital approaches in the sense of, it's obviously, it becomes location agnostic. Your ability to scale is, just your horizons get expanded very quickly. Customization of your interface, can also be done quite easily as with other regions that you get to, whether it's language or, what's the word? Just very, very colloquial, cultural, relevant material or content. If you're talking about issues around traction and onboarding, that can be easily solved with in-app or in-platform education. You don't necessarily have to go. Now we have options, web apps are becoming more and more progressive in the sense of it has the ability of a native app, but does not come with the initial data acquisition cost, if you will. So now I don't need 15 or 20 megabytes to download. So you somehow eliminate the cost. I've seen some innovative routes. I'm not going to mention which companies, but some companies are doing very well in terms of even thinking about zero rating their platforms, which I love. Why not? Take that as a marketing acquisition cost. And if you want to talk about marketing as well, by going up a very digital centered approach or digital focused approach, then you bypass a lot of traditional marketing in terms of customer acquisition. Now all of a sudden you don't need very expensive yet very obscure ways of being able to reach your end customer. So a billboard is cool, radio ads are fine, and they do work. I'm not saying they don't work, but your ability to use things like Facebook in particular, which has incredibly high traction, where you're able to also look at data points and be able to pick which specific SME of which region, of what interest, et cetera, et cetera, et cetera. And obviously stretch your marketing acquisition costs that can then make, can then subsidize, data, et cetera. So I mean, all these things are, I think it sort of tells its own story. It's the more, MFS Africa, the one thing is we always keep saying we want to make borders matter less, right? So digital tools, digital platforms going that route makes that a very strong reality for us.
Wow, thanks, David. That's a very interesting perspective, high tech, low touch. Perhaps to hear from you, Raman, we understand that Earth Finance works with what you refer to as nano entrepreneurs, and you earlier touched on the phygital approach that you deploy in serving this segment. Could you please tell us more on how you go about it and what the results are so far?
Okay, so again, the use case driven target group. So we have two set of customers who are digitally literate and who are yet to be seen more digitally savvy. So what we do, some of the problems have already been solved by the government, Indian government more precisely. We have public APIs, which help us to identify customer more precisely, which we have to follow as a part of our regulatory guidelines. So what it basically does is that we use a mix of technology, we use mix of public APIs, and we have been defining our model in a sense that that if you're reaching to a customer in a particular area and if you're onboarding as a mom and pop store, so with over a period of time, that how much sale or turnover a particular customer does in a month or in a season. So that kind of data we have always been gathering, and now the model says that, okay, so this is the right time and this is where the entire credit decisioning can happen based on the data. Then we have the context of KYC, we have the context of public APIs, we use it to the maximum wherever we can do. So once again, if you see the approach, it is pure technical, digital. What we are basically doing is that we are trying to enhance the customer experience so that I'm not asking customer to provide so much of data to onboard him as a part of our credit process. So with many tools coming, we are reducing the overall customer onboarding time. And with this, it creates a trust. So one of the discussion we had just a couple of minutes before that, what are the various components which can help us to create a trust? So imagine a situation where you're asking customer to go through battery of processes, and and the customer also feels a little bit exhausted that why it is taking so much time. But now with a lot of public APIs getting available, we ask his mobile number, we take his Aadhaar number, and we follow the entire process. Everything gets pre-populated from the entire database. And we basically ask a meaningful questions. For example, if it is a new to credit customers and this customer has not been onboarded so far by any of the mainstream finance player, we ask him about the household information and what are the soft data about how much a shop earns and how much, for example, if it is an FMCG or the mom and pop store, how much SKUs you sell on a daily basis. Over a period of time, my machine tells us that, okay, if this is the customer persona, so if he's telling that on a monthly basis, he earns this much of money, my system also guides that, okay, so this is the harmonized approach. It is not 20,000 rupees, it is say 30,000 rupees. So based on that, we take a credit call and we move ahead on this. Second target group we have is once again, a pure digitally driven process. The only thing is that in the first process, our team helps customers to onboard. In the second process, we feel that customer has anyway doing a lot of onboarding for other aggregators. So we send them an SDK, more precisely the way Maurice and Daniel, they were speaking about, so that they need not to be dependent on the mobile phone, smartphone. SDK works on any web app platform, basically a browser more precisely. You go through the entire journey. Once again, this is non-assisted self-onboarding. Machines take over. Machines guide what are the input to be taken. And finally, the credit decisioning happens. So one thing I wanted to mention here is that phygital or the digital still require one more dimension to the overall credit process, is that we work with a lot more aggregators because we do not go to the customers directly. So in terms of our approach, how we approach customers is that we have the local players, hyper-local players, then we have regional players, then we have national aggregators. So we work with all these players across the country and get into partnerships, and these partnerships help us to get customers onboarded.
Thank you so much, Raman. Very interesting perspectives here about perhaps moving more towards high-tech, low-touch, and the innovations that are coming up that are, strengthening fintech's ability to digitize MSEs and MSEs to adopt digital technologies for their businesses and to access finance. So thank you so much for sharing your views from MFS Africa and Earth Finance. Over to you, Swati.
Raman, if I could actually just stay with you, because I think you talked a little bit about it already around this trust deficit. So when we did our research, as I mentioned, our primary research with MSEs, this is something that came across quite strongly across the board, is that they're still a bit hesitant of financial service providers as a whole, but particularly digital financial service providers. There is a somewhat of a perception that they're less regulated. We don't know what they'll do with our data. I think you talked a little bit about how you're trying to address that issue through asking for less documentation and less data. Is there anything else in particular that Earth has done to address this trust deficit issue?
Yeah, so in a way, if you see, one is the technology piece. Second is I'll say emotional piece, which is basically that you have to handle customer experience quite well. So third thing that has happened to us that during COVID time, which has been a kind of a testing time for entire ecosystem in India and across the world. So we have taken extra measures here, and we have found our customer segment, whoever were in the need of credit, but they were not able to pay on time. So we provided extra assistance in terms of credit, so that during those testings time, they were able to, cross that, so the particular phase. So we have gone ahead and we have, provided credit. So the reason why we were able to do, Swati, more precisely, that we have been working with the customers for a long time. And data suggests that these are all credit-worthy customers. That this is basically, I'll say, extra, or I'll say the factor which has been forced upon them, or the situation was like that. The shops were not operating for long, so they needed a kind of liquidity bridge during that time, so that help our customers to cross that particular phase. Apart from that, we do a lot of customer engagement, which means one is, of course, on the credit side, on the technology side, we keep on reaching to the customers. We also work on the digital literacy part, and India being seen as I'll say a place where a lot of government intervention is given in terms of subsidies, subsidies, scholarships, or anything else which comes from the government. So what we do as a part of our onboarding process also, that we fill one more form extra from a customer, which basically says that, okay, if you belong to this particular area, so there might be a certain government programs which are running. So why don't you apply for that? So we handhold them, we assist them. What it basically does is that it creates a second layer of trust. One, of course, was more on the credit or the insurance on the payment side that we operate seamlessly. The fourth thing is that we also help our customers to avail all the interventions which government on a time-to-time basis does that. So if you see, it works in a tandem and it creates a trust. So slightly different from, I'll say, product-based approach. We are very careful when we offer our customer insurance product. For a very simple reason is that, of course, we let customer know that, okay, you're getting into contract, this is the insurance product. Apart from that, we also work with the insurance provider to ensure that as and when claim happens, it gets settled within the stipulated time. So over a period of time, if you see that customer also sees us as a player who's with them during testing times. It is not just that you are there only for the good times. We have always been seen as a player. We have been all-weather friend for the customer, if I put it in a nutshell.
That's very interesting. So you sort of along with them for the journey, but I think the point you made about being with them when during the really tough times with COVID, I think that I'm sure goes a long way in just not just building trust, but promoting stickiness. So they're more likely to keep coming back to us when they're looking for finance. Kaylee, what are your perspectives? I know you have a product that's almost risk-free for the customer, right? So you're coming at it from a very different angle. What are your perspectives around building trust?
Sure. Yeah, and maybe just before I go into them is to just also focus again, who are our MSMEs? They micro MSMEs. So they're these tiny little, saris or warungs, or in Kenya it's the duka store equivalent. That's who we're targeting. And I think I'd say there's kind of three things that we've done on this trust piece, which I think is absolutely key. Number one, we don't talk about credit. I think, I've seen this across the markets I walk in. You come in and you say credit, and people are scared of credit, rightly so. There's loan sharks, there's high interest rates. It's okay, they're scared of credit. I totally understand it. So we come in and we actually don't ever give cash. We give products, we give consignment, we give buy now, pay later. One is there's just kind of a positioning thing, is by not calling it credit, there's more of an openness. And at the end of the day, yes, it's credit, but no, it's not, because we're giving them products and we even give them the opportunity to take back the products. And that's something we started this product, we launched it during COVID. It's been going now for over a year. We've had zero defaults for this very risky market segment. And I think it's very much to do with the technology and the model. So we're not just giving any products, we're giving products that are relevant to our market segment. When we started this, it was COVID. We had products that were super relevant to them, that they were new. Our FMCG companies brought them out during COVID, and new is a risk for this type of outlet. And to convince them to buy something that they haven't bought before, when no one has liquidity, no one can afford to take a risk, it's a very big step. And that's how we came up with our consignment product, is we said, don't worry, we'll take the risk. Here's the product, put it in your store. We're coming back in 2 weeks anyway, because we do routing and we route these outlets. And when we come back in 2 weeks, if you sold it, great, we'll take the money. And if you haven't sold it, we'll actually give you another week and give you more time to do it. And I'm making this sound very simple, but there's a lot of technology that then on the back end supported that it's all monitored. When the commerce manager comes in 2 weeks, we see how many bottles are left, how many have been sold. And that's where the technology comes in, because I'm a big thing on people. And I think when you come to trust, again, you have to talk people, relationships. We didn't come on day one offered credit. We started offering credit once we were already knew these retailers, our commerce managers had a relationship with them. But then we took that relationship and we used the technology to manage that. We're not offering them credit for whatever they want. It's products that we believe that they can sell. So it's responsible credit. It's for products that are relevant to the market. It's us taking out the risk by saying, you know, if you don't sell it, we'll take it out. So I'd say, yes, trust is a very big thing. And I think that's where fintechs come in and digital financial inclusion, because it's that combination of the technology, the people, and then also the back end. You know, we've got AI algorithms telling us this retailer is close to a school, let's sell juice, or this type of retailer. So there's a lot of sophisticated technology on the back end that's doing the propensity scoring, and not just credit scoring, but also knowing what are the right products to offer to this micro retailer segment.
Thank you. And Tyler, really quickly, any thoughts from you? I know we're running short on time and want to keep some time for questions, but any thoughts from you on how Market Force has done it differently and how you've built that trust?
Yeah, I think Kaylee nailed it on the head. We've had many of the same experiences. I think there's kind of three core components to building trust here. First and foremost is a relationship-driven approach. So we too have agents that onboard, educate, and maintain the relationship with our customers. And that trust is both ways. Our agent relationship is also an input into the creditworthiness of the merchant. The second is really delivering consistently and reliably on your core value proposition. So we've built that beachhead of trust with our merchant network by delivering on our promise to provide them what they need when they need that. And when they know that you're in the journey with them, when they know that you're there for them, then they start to trust accessing financial services from you as well. That's why we see merchants storing money in our wallets and accessing credit. Similarly, they don't love the term credit, so we don't use that as well. I would say the third pillar is the financial education, because we have that human component. I know there was a question in the chat about resistance to credit. We likewise finance inventory, not cash loans. But the way we position it is, we know you can sell more than you have cash on hand to purchase. So this credit solution reduces your margins marginally via the fee, but you're earning additional income. And when it's repositioned in that light, we've seen significant uptake against it, and merchants increasing their average order volumes by upwards of 30+% when consistently leveraging the credit solution.
Thank you. So relationships, making sure that you give them products that are relevant to them. I saw that when we were out meeting some of your retailers, Tyler. The relationships are absolutely critical. Liz, I'll hand over to you for the last discussion, and then we can move on to Q&A.
Thanks, Swati. Yeah, so for this last question, I think we've heard a lot about the opportunities that fintechs have in starting from scratch, being creative, innovative, using the blank canvas, as Maurice put it. And we've also heard about the challenges with digitization and the innovations that are addressing those challenges, challenges to do with building trust and how we can overcome that. I think all the different fintechs represented here have very unique approaches, as just discussed, and also building digital capacities amongst MSEs. So this third question is around what are the top two challenges that digital finance providers continue to face, and what support do they need to address these challenges? And I'll start with you, Maurice. Perhaps you could speak to the cross-border policy challenges that you have faced as a fintech that's trying to drive access to credit across borders. What has been your experience, and how can those challenges be addressed?
Yeah, I think when I think about the challenges, I kind of related to the cross-border challenges is also access to capital. When you think about how do you scale a digital financial services product or business, you really need a sizable addressable market, right? And if MFS has done a fantastic job and probably the benchmark of building a scalable platform or product across Africa. But a lot of companies haven't been able to do that. So if you're in a market like India, EU, China, a lot of Asian countries, you have a large addressable market that you can attract capital to serve, right, and to get the resources to deal with the challenges of building it out. But I think in the context of Africa, what would really be helpful is some form of regulatory passporting, because what that would do is it broadens the addressable market of that companies can sell to potential investors and capital providers, which makes which brings in the investment needed to be able to more efficiently scale out those products. So that would be, if I had to do my one recommendation, is something along regulatory passporting within the African continent.
Wow, that's an interesting idea right there. I see Daniel clapping. So Daniel, what's your take? What are the top 2 challenges that you feel fintechs are facing?
Yeah, Tyler and I were both clapping. I was following her lead. I fully agree with Maurice 100%. There's a lot of regulatory fragmentation, right? Whatever market force is doing in Kenya, should they want to expand into Kampala or into Uganda, into Benin, into Niger, let's start from scratch. It's not an easy road to travel. So that's a huge one, obviously. What sort of licenses it is that you need, and look, regulatory safeguards are there for a reason, but there's a point at which innovation and the impact that it has, it's really deterred by certain blockers, which can, I think, in my opinion, to be honest, can be reconsidered. So that's a huge one. So I agree fully. But the other one is also actually related to regulatory fragmentation, at least in the African context, is also the KYC and KYB fragmentation, because whatever documents it is that I sign up with in Ghana might be very different to what I need in Ivory Coast, right? And this is something that we've encountered when you look at onboarding, as we look at digital platforms becoming the biggest way to acquire customers. You want to automate this. Gone are the days where you literally either have to have an agent who comes, looks at your ID, looks at, yes, it's you on this photo, etc., or looks at a hologram or whatever. Now we have third-party platforms, that can just take this data through algorithms, literally do proof of life, in terms of you smiling and saying, oh, okay, this person is actually there. It's not an image that's being held up to the camera, etc., etc., etc. Cross-reference that with national databases, and in seconds give you a response of whether this person is who they are at an individual level and also at a business level. And all this backend systems do not have to necessarily be communicated to the customer. Ethically, you obviously need to make sure you're ticking the right boxes, being cognizant of privacy considerations, etc. But yeah, I think the canvas, it's a phrase that's been used here, is there. The opportunity is there. However, I think there's a long way we have before we're able to truly turn that potential into something that makes a massive, massive impact. Because a lot of the people who are being represented in this panel, the founder of MFS Africa, my personal journey, or everyone here, starting up these ideas is not easy. It takes a lot of courage. It takes finding resources, knowing all those challenges, going through the whole entrepreneurial journey. And it is a little bit heartbreaking knowing, having a very strong why, very strong conviction, getting the teams and the people, but then having this barrier, which can be very easily addressed. Should we take a strong focus on having policy that embraces innovation while still considering all the risks included. So yeah, that's echoing very much what Maurice said, both fragmentation of onboarding details and also regulatory standardization. Thank you.
Yeah. Thank you so much, Daniel and Maurice, for your responses to this question. I think we're running out of time. Swati, do you have any questions from the chat?
We have a few questions, so I'm going to just quickly direct them at any panelist, but please feel free to jump in. I don't think we'll have a time to get through all of them. So the first question is from Yusuf Saldana. Raman, this is aimed at you. He says, Raman, an insight on India's AA network and how it benefits customers and assists and all the fintech players.
Okay, so as we were mentioning earlier that on the public APIs part, so account aggregator is one of the initiatives from the government. What it basically does is that the moment you have any relationship with any of the financial institution, you need not to ask the same thing from the customer. As long as you provide a mobile number and OTP, you will be able to fetch the details, say from bank A to bank B. So that's how the whole piece is going to work. So the good thing in the entire use case is that it is not only limited to the banking segment per se. So sooner or later, you will be seeing other regulators who are also becoming part of this, which is basically pension fund, mutual fund, which is SEBI, and any other regulator which comes. So any customer who has any relationship across investment, credit, payments, what are the products we have in the country, with the access to mobile number and OTP, you will be able to fetch the entire details from account aggregator framework. The good thing about account aggregator framework is that the pipe itself, the license entity, which is account aggregator company, is not supposed to see the data. It's basically acting as an infrastructure layer. You being a NBFC or a bank, take the consent from the customer and fetch that data from any other bank or any other financial institution. So what it is basically going to solve in the future is that any data, any relationship, or you want to customize your product, how much income a customer is making, how much is the customer is saving on a monthly basis. So all information comes at one go. You can run your machine models, the AI model, and finally suggest a curated approach to the customer. That's how it is going to shape up. Account aggregator is one, then we have ONDC, and then OK.
Thank you, Raman. And then we have a question. I think Tyler and Kaylee somewhat answered this, but perhaps Daniel, I could get you to take this one. Nyakaru says, how do you get end user customers to buy, and especially at the grassroots level where there is high financial illiteracy and resistance to credit? So I think Tyler and Kaylee already said you just don't tell them that it's credit, and they view it differently. But Daniel, your thoughts about this?
Constructive approach, but I'll change the wording a little bit. But I don't know. I think there's something to be said about any solution mirroring, the reality on the ground. So when you're building a solution, you want to make sure that it goes to the audience that will be the highest adopters, right? Whether that means they are closer to urban areas, semi-urban, or have some form of understanding. And more importantly, if I don't have, that's a weird analogy, but if I'm not close to any river or lake, please don't send me a fishing pole, because I don't need it, right? So therefore, make sure that whatever it is that you're building actually resonates with the people that you're building it for. Step one. So if this is something that is solving a problem, then the product will sell itself. If it's simple and doesn't need much education, and you've taken steps to make sure that the language, the mechanics, the value proposition speak for themselves, then of course the traction will be there. So as opposed to having to force a solution because of an imagined scenario, I genuinely believe in just meeting people with where they, where they're at, is how I'd answer that question simply.
Thank you. I think we have time for a very quick one. Maybe Kaylee and Tyler, if you could really quickly jump in on this. And it's around whether you have data on gender differences in product uptake and onboarding support. And, just really quickly, 10 seconds, and then Liz can wrap up before we need to close. Tyler, you want to go first?
Sure, yeah, we haven't fully disaggregated differences on uptake by data, but we do find that most of our businesses are women-led, and that they tend to appreciate access to this product because they understand that the additional income that comes in from access to lending helps them pay school fees, helps them pay health bills, and position that way, it's something that is quite valuable to them.
Kelly, I know you guys are very focused on gender as well.
Yeah, I mean, in a minute, but I think when you look at our retailers similarly, the majority are women. I think even more that we do have the data on it. We believe even more than the data. It's at least 50% in Indonesia, 65% in the Philippines. We think it's even higher. I think sometimes even when a woman's running a small store, there's a tendency to still register it in the name of the male. And this is something that we look at across the value chain. So it's not just the retailers, but also the commerce managers that are serving them, the wholesalers. I'm not going to try to get into the insights, but I'd be more than happy to discuss afterwards and maybe a follow-up discussion on the impacts of gender.
What I'll suggest is maybe we can respond to some of these questions via email for some of our participants. Liz, I'll leave it to you to wrap up, but I'm going to just say one last thing. Daniel said something, digital is here to stay. That's what I'm leaving this discussion with. Thank you, guys.
Yes, thank you so much, Sati, for that. And thank you to our panelists today for making the time to join this discussion. Thank you to the audience for listening in and sending through your questions. We'll pick up the remaining questions from the chat and try to send through our answers through the Financial Inclusion Week organizers. So thank you so much, and we look forward to continued discussions on the opportunities that are there for fintechs to serve the MSE segment.
Thank you all. Bye-bye.
Thank you.